Is recency bias just a trading problem? Have you ever noticed how recent events can cloud your judgment? This phenomenon is known as recency bias, and it impacts many areas, including trading. So, is recency bias just a trading problem? Let's find out. Recency bias is a cognitive bias that affects how we make decisions. It occurs when individuals give more weight to recent events than to long-term data. This can lead to poor choices in both stock trading and options trading. Traders often react strongly to recent price movements or news, assuming trends will continue. For example, after a stock experiences a strong rally, a trader might think the upward trend will persist. This could lead them to buy call options or increase their position size without considering the broader market context. On the flip side, if a stock has recently declined, traders might exit their positions too soon, fearing further losses, even if the fundamentals remain strong. In options trading, recency bias can significantly impact risk management. Traders influenced by this bias may chase recent winners, increasing their exposure to assets that have already peaked. They might also exit positions too early or too late based on short-term market fluctuations. This behavior can lead to neglecting diversification or hedging strategies, which are essential for managing risk effectively. Since options trading involves leverage and time-sensitive contracts, the effects of recency bias can be even more pronounced. Emotional reactions to recent market changes can lead traders to stray from their planned risk controls, increasing the chances of substantial losses. However, recency bias is not just a trading issue. It also affects long-term investors. They may shift their asset allocations based on recent performance or abandon systematic investment plans during downturns. This behavior can lead to chasing hot sectors without considering valuation or risk. To combat recency bias in trading, there are practical steps you can take. First, develop a clear trading plan based on objective criteria rather than reacting to market noise. Use historical data and volatility measures to guide your position sizing and strike price selection. Implement stop-loss and profit-taking rules to minimize emotional decision-making. Regularly review your performance with a long-term perspective to avoid overreacting to short-term results. Lastly, maintain a diversified portfolio to lessen the impact of any single recent event. In essence, recency bias is a broader behavioral challenge that affects both trading and investing decisions. In options trading, it poses unique risks due to leverage and time constraints. Recognizing this bias can help traders and investors stick to rational strategies that align with their financial goals.